All of the problems covered in my videos can be downloaded at accountingworkbook.com. If you go to the website, click the PDF link, you can download a copy of the workbook for yourself. Also on the website, you'll find links to all of my accounting videos, not just the ones I've uploaded to YouTube. I've uploaded over 100 extra videos on this website that you can't find on YouTube. So I do hope you'll check out accountingworkbook.com. All right, let's begin our problem. It's time to look at problem 6.3a. Inventory purchases, sales, returns. We'll look at discounts. We'll look at just about anything and everything that can happen to us as it relates to inventory. So a challenging problem and a problem that has us doing lots and lots of journal entries. Let's take a look. It says the following transactions occurred for Romney Inc. And there's a list of our transactions, and it says prepare journal entries for all of these transactions for the month of February. So February 1st, purchased inventory on account, $3,400, terms, $210 net 30. So, okay, as soon as I see we purchased inventory for terms, I know we didn't purchase it for cash. I know we purchased it on account, right? It even says on account there. So let's get to it. February 1st, and of course we're going to have debits on the left and credits on the right. Well, let's think of what our debits are. We got inventory. How much did we get? $3,400 worth. We're going to credit accounts payable because we have not paid for that inventory yet. You might be thinking, well, what about this discount stuff? Well, we'll worry about the discount stuff in a little bit, but remember what these terms mean. 210 net 30 means we get a 2% discount if I pay within 10 days. If I don't pay within 10 days, I have to pay the full amount within 30 days. That's the due date is in 30 days. Paid freight on the inventory, $200 cash. Well, we said the cost when we're costing an asset, we're costing inventory, freight gets included in the cost of the inventory. In other words, the cost of delivering that inventory to us is the cost of making that asset useful to us. So it adds to the cost of our inventory. So we don't debit freight expense here, we debit inventory to say, oh, we got more inventory, and it adds to the cost of our inventory. Debit inventory, $200, and this one was not on account. We paid the shipping company $200 cash. Paid cash, just in brackets there. Okay, February 5th, returned $400 of inventory from our February 1st purchase. Okay, so we're going to send back some of that inventory. Now, how do I send back inventory? Well, I credit my inventory, right? Because I'm sending it back. I think it was on the 5th. I'm kind of forgetting that. Let me scroll back up here. Yeah, February 5th. So $400 worth of inventory goes back. I send it back. I say, look, I don't want this inventory anymore. And I debit accounts payable to say, you know what? I'm not going to pay you for this inventory I'm sending back. So there we have it, February 5th. It doesn't say why we returned it, but the fact that we returned it and assuming that, there's no dispute here, they accept it. There's our journal entry for February 5th. February 9th. Okay, we're going to have a bit of work to do on February 9th. Paid for the inventory purchase of February 1st. Okay, so February 9th. I'm going to be crediting cash, but let's figure out for how much. Now, we bought the inventory for $3,400, but we returned $400, and we've paid the freight. The freight's going to have nothing to do with this entry. So the freight's just separate. So $3,400, return $400 means I owe $3,000. Now, if I pay them, should I pay them the full amount? Well, the answer is no. Look, if they gave me a 2% discount, I don't need to pay the full amount because I'm paying within 10 days. February 9th is less than 10 days from February 1st. I'm paying within the discount period. So how big is my discount? Well, $3,000 times 2% means I'm going to save $60 on this deal. Again, I owed $3,400, but I returned $400 in inventory. So really, I'm only owing $3,000, and I'm going to take a 2% discount on that $3,000. So I'm going to take $60 off my purchase. So again, $3,000 is what I owed minus $60 means $2,940 is the amount of cash that's going to have to leave my hands. So, credit cash, $29.40. Now, I owe these guys, and just looking at my AP, if I look at these transactions, I owe them $3,400 there. $3,400, let me just highlight. $3,400 based on the February 1st transaction, and I reduced that by $400 based on the February 5th. Those are the only two journal entries that hit my AP, my accounts payable. So I owe them $3,000, and if I paid them, when I paid them $29.40, I don't owe them anything anymore. I don't owe them the $3,000 anymore. Like, I don't owe them anything. I don't still owe them 60 either. So I've got to get rid of the entire AP because I owe these guys nothing. So I got to get rid of a $3,000 payable. And now we're left sitting here thinking, well, we're off. We're $60 off here. Why are we $60 off? What is the difference? Well, the difference goes to inventory. And I'll explain that in a moment. And it's the amount of the discount, right? You might think, why am I not crediting discount? Why am I crediting inventory? The reason we credit inventory is because the cost of any asset is really what you paid for it. And what did we pay for our inventory? We paid $29.40 for our inventory. So we go debit inventory, $3,400. Oh, and ignoring the freight aspect of it for the moment, $3,400. We credit inventory $400, so there's $3,000 worth of inventory. We paid $29.40 for it, so we have to reduce the inventory's value by $60 to say, oh, I paid less than I thought it was. If this person gave me an 80% discount, as strange as that would be on the inventory, I can't say, oh, I've got these thousands and thousands of dollars worth of inventory if I got 80% off. The cost of the inventory is what you paid for it. So we paid $29.40 plus we paid $200 freight. If you look at the inventory on our books, $29.40 what I paid for it plus what I paid for the freight, the inventory should be on the books for $31.40. Let's see if it is based on these transactions. I went debit inventory $3,400, debit inventory $200, credit inventory $400, and credit inventory $60. When you crunch those numbers and when I crunch those numbers, what you find is $3,000, $3,200 minus 60. We do end up at $31.40 in inventory, which is exactly where we ought to be based on those transactions. So I hope I've made this clear. I feel like I'm talking myself in a bit of a circle, but I hope that this is at least reasonably understandable. Let's continue. That's February 9th in the bag. February 11th, sold inventory for $3,500 on account. The inventory cost $1,600. Terms $210, net $30. Okay, so we've just, these four are all about purchasing inventory. Now we're going to look at selling some inventory. Selling inventory on account. When I sell inventory on account, there's always two pieces to the puzzle. One to record the fact that I've sold something. The other to record the fact that some inventory walks out the door with my customer. So let's start with the sale, $3,500 on account. So normally when we sell something for cash, we debit cash. If we sell something on account, we debit AR, $3,500. We're going to credit sales revenue because we've earned some money here, $3,500. Now, what did that inventory cost? The inventory cost $1,600. So the customer walked out the door with some of my stuff. How much stuff? Was it $1,500 or $1,600? Oh, $1,600. They walked out the door with $1,600 of my stuff. Now, the other piece of this is cost of goods sold, right? It's that COGS expense. It's an expense that gets top billing on our income statement, as we'll see in subsequent videos when we prepare income statements for merchandisers. But it is a special expense, and it's an expense that's related to the cost of the things that we sold, right? When Walmart sells me a pair of socks, they've got to keep track not only that I'm putting $5 or $10 in their till, they've got to keep track of the fact that I'm walking away with some of their stuff, right? I walk out the door with their socks, that's some of their stuff. So that's the way a merchandiser keeps track that their customers are walking out the door with their stuff. This is how they do it under a perpetual system, and that's really the only system I'm going to cover in these videos. If in your class you're doing periodic system, it's a little bit different. Okay, February 14th, Valentine's Day. very sad day for me year after year after year. Now I'm married. It's a happier day, but a long, long drought in my life, a sad day. February 14th, purchased inventory on account, $2,500. Okay, we buy inventory on account. This is pretty easy. February 14th, debit inventory, credit AP. We bought inventory on account. 2,500. So not much to say about that. It does have terms, and actually our last sale had terms, 210 net 30. This one is 115 net 30, so different terms, but we know what that means. I get a 1% discount if I pay within 15 days. I got to pay the full amount within 30. February 19th. Oh my goodness, another sale. So we're kind of juggling. There's a few balls in the air right now, right? Few things to keep track of. These 3 transactions, we got to keep track of which one's which. Sold inventory for $1,500 on account. Okay, so we made a sale on account, just like February 11th. I haven't forgot the date, but I know I'm going to be debiting AR and crediting sales revenue for $1,500. What was the date of that? That was on February the 19th, and the cost of the inventory was $600. Again, there's terms there. I'll worry about the terms when they come around and pay. Right now, I'm not going to worry about the terms. So the cost of the inventory was $600. So COGS was $600. This was February 19th. Debit COGS $600. Credit inventory, to say some inventory walked out the door with my customer for $600. Okay, there's February 19th in the bag. Again, there's terms, 2% discount if they pay me within 10 days. Net amount is due within 30. February 21st, paid for the inventory purchase from February the 19th. Or from February 14th, pardon me. Okay, so we paid for the inventory purchased on February 14th. February 14th to the 21st. We paid in like 7 days. I get a 1% discount if I pay within 15 days. So I'm getting this discount. It's $2,500 times 1%. It's a $25 discount. So rather than paying $2,500, I'm going to pay $2,500 minus 25. I'm going to pay $2,475. That's what I'm going to pay for this. So let's pay $2,475. Now, of course, I had a liability here. I had a payable. When I bought the inventory here on February 14th, I had a liability of $2,500. I got to get rid of that liability. I don't owe them a cent. I've paid them in full. Even though I only pay $2,475 in cash, I've paid them in full. You'll recall our other credit here goes to inventory. And the reason it goes to inventory is because we only want to put the asset on the book for what we paid for it. And we didn't pay $2,500 for this inventory. We paid $2,475. If I buy a new car and the car's on the lot for $20,000 and I bargain and barter and I get it for $15,000, I don't have a $20,000 car. I have a $15,000 car. People will play mental games themselves. I got a $20,000 car, but I only paid $15,000. Well, then you didn't get a $20,000 car. You got a $15,000 car. I didn't get $2,500 worth of inventory. I got $2,475 worth of inventory based on this transaction. Okay. Let's continue. February 24th. Customer from February 11th transaction paid the amount owing. Okay, so February. Whoa, that was an unexpected scroll wheel attack. Let me make sure I got my pen out here. February 11th turns around and pays us on February 24th. Let's see. Well, you know what? They got to pay us the full amount because look, February 11th, the terms are 210 net 30. Well, February 24th, that's more than 10 days away. They didn't pay us in the discount period. They paid us on time. They don't owe us any penalties or anything. They're a fine customer, but they just don't get the discount. So we're expecting to get the full amount that they owe us. How much do they owe us? They owe us $3,500. I mean, they're not getting their discount, so they're going to pay us the full amount. Again, I always forget the dates, but let's deal with this. Debit cash, 3,500, and credit AR. Oops. 3,500 to say, hey, they've paid. Let me date this thing. February the 24th. Saw the next one was February 25th. I didn't read it, but I'm just going to write the date because I always seem to forget those. February 25th. The customer from the February 19th transaction. I'm going to erase a little bit of this just because it's getting congested. Okay, February 25th. The customer from February 19th. So this customer right here returns $100 of inventory, cost $40. Inventory is in good condition and put back on the shelf for resale. So the person just, for whatever reason, they bought $1,500 worth of stuff. They bring back $100 of the stuff just saying, I didn't want it, or I bought too much, or whatever, but it's still good, and that's important to note. It's still good. So what's our entry for when somebody returns something, but it's still good? Well, we debit an account called sales returns. This is a contra revenue account. Sometimes it's called sales returns and allowances. I'll put and allowances in brackets. But this is just really a sales return. They returned $100, and we said, you know what, it's good, so you don't owe us that $100, right? We refund them $100. We're not going to give them cash of $100 because they haven't paid us yet. So we're going to say, okay, well, we'll put the credit on your account, right? When you go to pay your bill, pay us $100 less as a result of this transaction. Now, the fantastic news was it wasn't like they showed up with broken inventory that we couldn't do anything with. We just had to throw in the garbage, which does happen. This was very good inventory that we were able to put back on the shelf. So we have inventory. They gave us back an asset. Let's put that inventory back. Now, how much was it? $40. That was the cost of the inventory they returned to us. And again, it was in good condition. We put it back on the shelf. So debit, inventory, $40. And we credit COGS 40 to say that reduces our cost of goods sold because that was inventory we had called sold before. It's no longer sold, so it's no longer inventory that's been sold. Okay, last but certainly not least, let's scroll up. February 28th, the customer from February 19th pays. So the same customer we've just been talking about, their terms were $210 net 30 on February 19th. They did pay us within 10 days, so they are going to get a 2% discount. How much are they going to pay us? Well, $1,500, but they returned $100 worth of stuff, and we said that was legitimate. So it's $1,400 that they owe us, and we got to assume they're going to take their 2% discount, which amounts to a $28 discount. So how much are they going to pay us? Well, they owed $1,400. They got a $28 discount. $1,400 minus 28 is $1,372. I always want to know what we're going to get paid or what we're going to be paying. So we're getting paid here $1,372. Debit cash. $1,372. Oops, sorry, I'm just wanting to scroll back up here. Okay, so the next thing to worry about, well, do they owe us anymore? And the answer is no. So I got to get rid of their account receivable. Their account receivable, again, was $1,500, but then we credited it by $100, so it's only $1,400. So I'm going to credit their AR for $1,400. And as you can see, I got a debit of $1,372, a credit of $1,400. The missing amount is the amount that they got discounted. This amount gets debited to an account called sales discounts. This again is a contra revenue account, just like sales returns is a contra revenue account. So revenues we always credit, these ones we debit it. The amount of this sale, if you look at it from cradle to grave, right? We sold $1,500. They returned $100 and they got a discount of $28. So if I look at my sales rev, it was 1,500. My discount, I'll do my return rather. My return was 100, and my discount was 28. And remember, this is a credit; these two are debits. So if I just like sum up these numbers, I end up at 1372 in credits. Well, that's the net sales revenue, right? That's how much I actually really earned from the deal, right? Even though I sold $1,500 worth of stuff, they returned 100 and they took a $28 discount. So my real sales is 1372. So this is the number that winds up getting reported to shareholders when we prepare and look at financial statements. So there we have it for this video. I hope it was useful to you, and I hope you'll stay tuned for the next one. Bye for now.